Hello, I'm Stephen Weitzel, Managing Partner at Reveille Wealth Management. Over the course of this 9-minute tutorial, we'll examine our rules-based investment discipline from a 30,000-foot level. At Reveille, we believe the foundation to helping our clients achieve their goals is rooted in financial planning. It's through the financial planning process that we determine what rates of return or levels of risk are required over time to help our clients meet those objectives. From a fiduciary perspective, this information is vital to us to be able to recommend an investment strategy that will support our client's financial plan. But we do not believe that a simple mix of stocks and bonds is the solution. Unlike many in the investment community, we don't subscribe to the conventional investment advice of buy and hold. While having a diversified, asset-allocated investment strategy is important, those elements alone will not help investors preserve assets during bear markets. Managing the downside risk in a portfolio is just as important as capturing the upside. We believe that it's better to have an investment strategy that can adapt to changing market conditions and pivot to cash at certain times versus constantly maintaining a predetermined investment allocation and riding it out. Our rules-based investment discipline, or RBID for short, is designed to help us identify market trends. Aligning with market trends enables us to proactively manage portfolio risk by helping us to gauge whether or not we should be invested in a certain area of the market. If markets are going up, we want to own them. If markets are going down, we don't want to own them. Very simple. Here's an example of our rules-based investment discipline in action. This chart of the Dow Jones Industrial Average illustrates how our focus is to discern the primary trends and inflection points within those trends inside of different areas within the market so that we can align ourselves with those trends. We don't want to be fighting market trends. Rather, we want to be positioned along the side of prevailing market trends. For this chart in particular, this is a 5-year period examined on a weekly time frame. That means that each one of these dark tick marks or bars represents a single week's worth of price action. The red line represents a short-term average of those weekly price changes, while the blue line represents a more intermediate to longer-term average of those same weekly price moves. RBID suggests that when the short-term average, the red line, pierces through the longer-term average, the blue line, a change in market trend has occurred. Specifically, when the red line crosses the blue line from the top to the bottom, this represents the end of an uptrend, the onset of a new downtrend, and we want to sell and move to cash. Conversely, when the red line crosses the blue line from the bottom to the top, this represents the end of a downtrend, the onset of a new uptrend, and we want to buy and be invested. Of course, RBID is not a crystal ball, so even though we've identified that a new trend may be in place, we do not know how long this new trend will last or by what magnitude the market may rise or fall. What we do know is that in their infancy, all of our buy signals and sell signals have the exact same characteristics. What happens after each signal will be different every time. But what's most important for us is that when we're given a signal, that we take action, we change our exposure, and we adapt to the new prevailing market trend. We just saw an example using the Dow Jones Industrial Average of how RBID helps to identify market trends. At the portfolio level, we apply that same process to each asset category, stocks, bonds, real estate, and commodities, on a weekly basis to determine whether the trend in each is up or down, or on or off as we call it. If an asset category is producing a buy signal, that sleeve of the portfolio will be invested according to its weighting within the strategy. If the category is producing a sell signal, that sleeve will be placed into cash or a cash alternative until a subsequent buy signal is produced. Here's a hypothetical example. In step 1, the pie chart represents a diversified portfolio where each color corresponds to a specific asset class. Within this strategy, the light green sleeve may represent 10% of the overall allocation, and it could provide exposure to corporate bonds. If corporate bonds are turned on according to RBID, then we will own a full position in corporate bonds, and that slice of the pie will be fully invested. But if corporate bonds are turned off, we will not own any corporate bonds, and that slice of the pie will be sitting entirely in cash until a subsequent buy signal is produced within the category. When a signal is produced within a given asset class, it will have no influence on the other asset classes. Just because a category will turn on or off doesn't translate into the same action being taken with the others. Each component will be examined independently to determine, based on its own merits, whether it should be included or excluded from the portfolio. So at one end of the spectrum, if we were in a bear market environment where every asset category was in a downtrend and turned off, we would be 100% out, sitting in cash or cash alternatives. On the other end of the spectrum, if we were in a bull market where every asset category was in an uptrend and turned on, we would be 100% in, fully invested. And while our rules-based investment discipline may tell us when to buy and when to sell, it doesn't tell us exactly what to buy or how much of a given category we should own. It's at this stage in our process when we utilize our inner market analysis to identify what we believe is the best way to be exposed to the market. For example, if we received a buy signal for large cap US stocks, is there an area within the asset class that we want to favor, such as growth or value? Also, how much of the portfolio should this represent? Should it be 10%? Should it be more? Should it be less? For our exposure to the bond market, should we own more long-term bonds or more short-term bonds? Should we have a preference for U.S. Treasuries or high-yield credit? The intention behind our process is to answer these questions without inserting our opinion, emotion, or human biases, focusing solely on aligning with market trends. In short, because markets go through cycles, we believe it's important to have an investment strategy that adapts to changing market conditions. Our rules-based investment discipline helps us to first identify the primary market trend and answer the question, do we want to be invested in a certain area within the market? If so, how do we want to be invested in that market? And lastly, which investment vehicle or fund is the best expression of that point of view? We hope that this overview has been helpful for you. If you have additional questions about our rules-based investment discipline or how our inner market analysis is incorporated into RBID, please reach out to us. Send us an email to info@reveillewealth.com or contact your Reveille Wealth Management financial advisor to learn more. From all of us here at Reveille, thank you. We look forward to serving you.